Our next guest says with rates this high, it's not time to add credit, but to look at the longer end of the curve to offset the risk. Joining us now is DoubleLine Capital Deputy Chief Investment Officer Jeff Sherman. What do you mean, Jeff? What's the strategy around fixed income right now?
Well, Sarah, it's been the same trade we've been advocating for really the course of the summer, and this is having a balanced portfolio of risk. And when I say don't add to credit, it doesn't mean that you shouldn't own credit. But this is not the time with yields where they are today to be going down and reaching for the bottom tiers of credit. And so you can be good enough in the credit markets today. We have investment grade bonds that yield 6% today in corporate credit in the U.S. You have high yield bonds at the upper end of the higher end of the credit ratings that yield in the 7, 8, 9% range. And so there are places in the credit markets that still make sense. But in order to do that and be comfortable with some of those risks, why not own some of this treasury market as well? And so, as you mentioned, we went over 5% in overnight trading this morning. And it seems like it just all of a sudden was a catalyst when kind of the U.S. market woke up right at that 5% mark. It really sent buying into a frenzy today. And so, again, this isn't something where investors have missed this move to date. It's owning these balanced risk in a portfolio, in a bond portfolio that nowadays yields 6.5% to 7%. That sounds a lot more attractive of getting a return that's pretty likely to have those levels versus taking some speculative risk, as you mentioned, with all the geopolitical risk out there today.
What ultimately, though, do you think turns the tide on this bond sell-off we've seen?
Well, ultimately, you need people to wake up and say that this is a level where you feel comfortable owning this through the cycle. And I think as we grind through the year, the technicals have been horrific on the bond market. We've had all this issuance that we keep talking about, the massive deficits. We have a dysfunctional government that says maybe we don't get any relief in any of these factors going in the short term. But ultimately, as investors are looking to position portfolios for next year, you're going to see a big turn in people looking at the bond market. The stock market, even for all the pain we've seen in the last, let's say a couple of months or so, or last month or so, you're still up over 10%. And so there's this natural rebalancing. If you go through last Friday, the Barclays U.S. aggregate, or the Bloomberg U.S. aggregate, as it's called now, is down 3.1%. This is the worst performing year, but outside of last year, if the year stopped as of last Friday, it'd be the worst year on record, second worst year on record for bonds. Sorry, I can't speak this morning. But ultimately, I think what you'll see is investors waking up and saying, wait a second, 5% on a treasury market, I don't have to take risks. I can lock this in for a prolonged period of time. And you're seeing that with institutional buyers. At least we've seen that with some of the longer duration, the people who own longer treasuries come back into the marketplace and start to get excited about these yield levels.
Jeff, I wonder how you're thinking about credit quality and some of these delinquencies, late payments, in the face of what appears to be still a very robust labor market, and how that picture changes if, in fact, employment also rolls.
Well, Carl, as we always say, the recession occurs as soon as the labor market rolls over. And so you are starting to see delinquencies. There was some news out last week about some of the highest delinquency rates you've seen on autos. We're seeing this in lower quality borrowers in the subprime mortgage market as well, lower FICO scores, increasing delinquency. And you're seeing some just broad-based in consumer, whether it's credit cards or other type of consumer loans. And so the problem with looking at measures like GDP, which we'll get this week, which is expected to be a very strong number, is that it is very backward looking. And so the labor market is one of the last things to kind of roll over there. But you are seeing some weakness in credit. And it's the resumption of student loans coming back into the market. Again, that really hasn't trickled through the economy yet. But you guys were talking at the onset of this program about higher energy prices as well and the risks there as well. And so don't forget that a lot of consumers, the pain point they feel, number one, are the prices at the pump. And also as we go into the heating season or the cool winter season, was a demand for higher oil prices too, or higher energy. It takes a bigger part of the overall budget and discretionary spending. So again, just because the labor market has been resilient doesn't mean it will continue. So far, you just have this kind of inflection point in the market. Either we're going to continue to grind along and this economy is going to be great for the next 6 to 12 months, or you're going to start to feel a little bit more pain. And so far, some of that data is starting to show a little bit of cracks, but it's too early to say that it's a recessionary call today.